Hello and welcome to this edition of Hardman Talks. My name is Keith Hiscock. I'm the CEO of Hardman Co, and I'm joined today by Nigel Hawkins, one of our very experienced analysts. Nigel's analysed the infrastructure space since the electricity companies were privatised in the 1990s. He's just published a note on the renewable and infrastructure investment company space, focused on network reliability. Great to have you here today, Nigel.
Pleasure.
The reliability of power supply has been in the headlines quite a lot recently. Obviously, we all know about Heathrow having to completely shut down for one day because one transformer blew up. And then just a few weeks later, the whole of Spain and Portugal was plunged into darkness. Against that kind of background, how has the combined sector infrastructure investment companies and renewables energy infrastructure funds performed in recent months?
Well, certainly it's been a pretty challenging few months for any company involved in the electricity sector, whether in Iberia or indeed in the UK. What they really need, though, is to close the net asset value gap. We've got some of these funds trading at way below net asset value, 30%, in some cases higher. We've seen a number who have had to basically give up and go into managed wind down. So it's been quite difficult. Yes, some like 3i Infrastructure have done pretty well, but for most of them, it's a question of either treading water or in some cases, hoping for a bid, which has happened for 3 of the stocks concerned.
Have the discounts to NAV closed as a result of this sort of activity?
Yes, for the 3 companies involved in bids, BBGI, one of the really good companies in the IIC sector, that has accepted a bid and is now delisted, and the bid was close to net asset value. We've also seen a bid for Harmony Energy Income, and again, that really closed the gap since the bid was close again to net asset value. And there's also a bid out there for Downing Renewables Infrastructure. And again, the gap at NAV level has closed very substantially. But for many others, without bids and the difficulty of accessing new capital from the equity markets makes it very, very challenging.
Yeah, so there's been quite a lot of bid activity, which is going to be one of my next questions. I think you've mainly answered. One of the reasons people invest in this sector is because historically there were quite big dividend yields. How safe are the sector's dividends?
Well, it does very much more than previously. At the top of the market for the sector, 3i Infrastructure, that's going to be increasing its dividend this year by around 6.4%. That's pretty good. Many of the others are having very marginal increase in dividend. In a few cases, dividends are being cut. And where it's actually quite complex is for those in managed wind down. We've got a situation where dividends will only be paid when they sell the assets. So it's anything but a clear stream of dividend payments. But it does vary so much. 3i Infrastructure at one end of the market and some of the others, which are about 5 in managed wind down.
So, given the discounts in the sector, does this mean that fundraising is a non-starter for most of these funds?
Yes, most of the companies are actually very honest about that, saying, look, we simply cannot raise money given the current net asset value discounts in equity markets. And therefore, particularly those with high debt already, it's actually very, very difficult. There are one or two, 3i Infrastructure being one, and the most successful of the telecoms orientated IICs, that is Cordian Digital Infrastructure, that has done very well. Those two possibly might be able to raise some money if they wanted it, but for the majority, they have to assume, I think, that for the moment, until interest rates come down, if indeed they do come down, the UK equity markets will be very, very difficult to access.
You used the term earlier on managed wind down that some of the funds are in. Can you just briefly explain that and where they are at the moment?
Well, those particular stocks, 2 of the Aquillas are in management wind down, and there are 1 or 2 others who are essentially saying, look, our shareholders want out. They want the assets to be sold at the best prices available. In some cases, that is reasonably straightforward. In other cases, it's going to be desperately difficult. And then after the assets have been sold, they can then say, right, we'll return the value of the sales proceeds to shareholders. And they'll also be hoping that what they actually achieve in selling these assets is close to net asset value. And in fairness, in some cases that has happened, although you could argue that net asset values have been pushed downwards to reflect the likely sales 6 to 9 months out.
Interest rates haven't fallen as fast as we would have hoped a year or so ago, but there might still be more to come. Would they boost the sector?
Certainly interest rate cuts would really help the sector, but they'd have to be A, be substantial, and B, I do have to question at present, despite what people are saying, whether we will see substantial interest rate cuts. The inflation figure here recently was 3.6%, and with all the inflation elements within the system, there is a case for arguing interest rates over the next 2 years might well be higher rather than lower, which will put even more pressure on these stocks. So yes, they really would like interest rate cuts. That's beyond really their ability to influence. So they're really having to say, look, we'll look after our own fund, look after ourselves. In some cases, take everybody's doing it for them. In other cases, they have to hunker down and hope that things improve.
And can I add a question in there so that investors can understand the impact of lower interest rates? Is it about debt that interest rate cuts are important, or is it about the discount rate to calculate the NAV?
I think it's a number of factors, and certainly the valuation element is pretty important. But as you rightly say, in some cases, they have geared up quite substantially, not massively, but you've only got to look at one of the telecoms companies, Digital 9 Infrastructure. That is now in management wind down. It raised hundreds of millions some years ago, and frankly, there was very little left apart from one major asset. So in their case, equity markets are simply not accessible, and they just have to hope that there are many assets can sell for close to net asset value, which in their case actually has been written down very substantially over the last year or so.
So final question, Nigel, is about the battery storage sector. So the battery storage companies own sites which have got lots of big lithium ion batteries to store energy when it's in abundant supply to then resell when there's a shortage. And investors got very excited about the sector. What's been happening in it recently?
Well, investors' excitement went down very substantially early last year when Gresham House Energy Storage, the bellwether of the three companies, announced a massive profit warning. Shares plunged. But more recently, their shares have recovered on the back of some very substantial underwriting of revenue going out. They've got some very good contracts, which they recently confirmed, and that will certainly underpin them for the next few years. Of the other two, Hardman Energy Income, as I mentioned earlier, is now being taken over and is being delisted. And the third one, Gore Street Energy Storage, despite a few ups and downs in recent years, is now announced a major deal on investment tax credits in the States, which is selling, and said, look, we're selling these ITCs and we're going to be able to increase our dividend more than we thought on the basis of the money we're getting for these ITCs. So that's the three stocks for very different reasons. They've actually had a rather good few months compared with some of the other companies across the wider sector.
Nigel, thank you for your time.
My pleasure.
So you can view Nigel's paper for free on our website. That's hardmanco.com. As always, thanks for watching. Please don't forget to like this video and join in the conversation wherever you're watching, and we'll see you next time. Thank you.